Lesson 1. Let's have a look at some definition. AASB gives a definition of depreciation. We learned something about the AASB in the earlier part of your course. You'll see in front of you a definition which is given by the AASB. Now this definition is a little bit complex at this stage. I've given you another definition of depreciation there. So depreciation is the term used for expensing the cost of a depreciable asset against revenue over its economic life. So what do we mean by a depreciable asset? Depreciable assets are not items intended for resale in the ordinary course of business, but they are bought to assist in earning revenue and provide this benefit over a number of accounting periods. So they're not those items which we're buying with the intention of reselling in the short term. Some examples of depreciable assets are machinery, furniture and fixtures, computers, office equipment and motor vehicle. Now what do we mean by the asset cost? The cost of a non-current asset or a long-lasting asset includes the purchase price plus any costs incurred in bringing the asset to its required location and to make it ready for use. It does not include cost of the GST, so please do not include that in the asset cost. Let's work out the cost of a motor vehicle. That includes its purchase costs, its delivery cost. That means the cost to get the motor vehicle from the warehouse to the dealer. The insurance cost from the warehouse dealer is also included in the asset cost. The question I'd like you to have a look at later on in the discussion board is, are the insurance premiums part of the asset cost? I've started a thread in lesson 1 on the discussion board for you to think about this. The asset cost also includes signage. What is meant by useful life? Again, AAS 116 gives a definition of this. It's the period over which an asset is expected to be available for use by an entity. The second part of this definition we'll ignore at this stage because we don't need to know about it in this course. What is meant by the residual value? Well, AASB again gives a definition of what is meant by this term. So the residual value of an asset is the estimated amount that an entity would currently obtain after it sold it or disposed of it. So let's tie these terms together. Depreciable amount is the cost of an asset less its estimated residual value. Now this might help to explain whether the annual insurance cost is part of the asset cost or not. Well, what's the difference between capital or revenue expenditure? Or what's the difference between capital cost or revenue expenditure? Now, any expenditure that provides benefit to an organisation beyond a 12-month period is considered to be capital expenditure, or the cost of an asset. Expenditure that will provide benefit to an organisation for not more than 12 months is considered to be revenue expenditure. So go to the discussion board again and try and answer that question. Are the insurance premiums, which are paid on an annual basis, part of the asset? Let's have a look at the accounting entries for the purchase of non-current assets on credit. We've got machinery there of $65,000 which will debit because it's an increase in asset. That GST paid, which is debit because it's an increase in asset or a decrease in liability. We credit accounts payable because it's a liability which is increasing. What I'd like to do now is to go to self-test exercise number 1 on page 9. You can stop the video at this point. Now, why do assets depreciate? Well, there's three main reasons. They depreciate because of physical deterioration, obsolescence, and passing of time. What I'd like you to think of is some examples of assets that would just physically deteriorate. Example of assets which would become obsolete, or assets which would depreciate because of the passing of time. We have to distinguish between depreciation expense and accumulated depreciation. A depreciation expense is of course an expense, and accumulated depreciation is a negative asset. There are three methods of calculating depreciation: straight line method, or prime cost, or fixed installment diminishing value, and there's also the unit of production method. Now, we're not going to be studying this much in this course, only because it is not accepted by the tax department. Now, how do we work out depreciation using the straight line method? Well, the depreciation amount is calculated by dividing the depreciable amount of the asset by the estimated life of the asset. What I'd like you to do is to have a look at the next slide and then complete self-test 2 on page 15. Here's an example of straight line method. You'll see there that we've got the asset cost of $35,000, residual value $5,000, and the depreciable amount is $30,000. There's a figure there, 28.5% per year. What I'd like you to do is to go to the discussion board and work out how that 28.5% was calculated. Now, how much is the depreciation per year using the straight line method? In this case, it's $10,000. That is, it's the depreciable amount of $30,000 divided by 3 years. See that in the first year, it cost us $35,000. The carrying amount is the amount that it's worth at the end of a particular year. At the end of June, the carrying amount is $25,000. Now, how do we work that out? We know that the depreciation for the year is $10,000. So what we do is we take the $10,000 away from the $35,000 to get $25,000. Depreciation at the end of the second year was $20,000. That's $10,000 plus $10,000. The carrying amount at the end of the second year is then $15,000. You can probably work out for yourself how the carrying amount is worked out at the end of it. Diminishing or reducing balance method. The depreciation in this case is calculated by applying a fixed percentage rate to the carrying amount of the asset at the end of the previous period. Therefore, the amount of depreciation charged is greater in the earlier years than in the later years. It's very important that you ignore the residual value in this case, as it's already been factored in the depreciation rate used. Now, what I'd like you to do next is to look at the next slide and then complete self-test exercise 3 on page 17. The asset cost in this case is $80,000. Remember, there's no residual value, so the depreciation amount is also $80,000. Depreciation rate is 40%. Now, the cost of the asset was $80,000 at the beginning of the period. During the year, the asset depreciated by 40%. So the depreciation then is $80,000 by 40%, which is $32,000. So the accumulated depreciation at the end of the first year is also $32,000. Remember, the carrying amount is the carrying amount at the beginning minus the accumulated depreciation. At the beginning of the next year, the carrying amount is $48,000. So So what we do, we multiply that by 40% to get 19,200 depreciation for that year. The depreciation for the 2 years then is 32,000 plus 19,200, which is 51,200. So the carrying amount at the end of the second year is 80,000 minus 51,200. I'd like you to have a look at the rest of the example and make sure that you understand how the carrying amount is worked out and also how the depreciation is worked out per year. At this stage you should stop the video and complete the self-test exercise. In the next 2 slides you will see a description of the unit of production method plus an example. Now in this course we're not going to spend too much time on this because it's not allowed by the taxation department. Now let's have a look at the accounting entries for depreciation. You see that depreciation is debited because of an increase in expense. Accumulated depreciation is credited because it's a decrease in liabilities. The next journal entry involving profit and loss, we're going to ignore at this stage because it's going to be covered later on in the course. Now here's the journal to record depreciation. You see the amount here is 12,000. I'd like you to start thinking about your assessment in this unit of study. Your assessment is already available in the assessment section of Connect, so you can download it any time you like. There are already some questions which you may like to attempt. Now please watch the short video before starting any assessment. If you don't want to, you don't have to start the assessment at this stage. If in doubt, could you please wait until after lesson 2. I'd like you to start thinking about your groups. You've got about 2 weeks to form groups of 3 in preparation for the second part of your assessment. Well, please go to the discussion boards to organise your groups. You'll be given more details about your groups later on. Now, what are the activities that you've got to complete for lesson 1? Well, there's self-test exercises 1, 2 and 3. There are also the review questions 1 to 16, which you can start now if you want to. If you don't want to, you can hold off until we get to lesson 2. You'll see that they are on page 46 and onwards. You can, if you want to, you can download the assessment and make a start to it. Please watch the video on assessments before attempting any assessment. If you've got any questions, please go to the discussion board. The answers to the self-test exercise are at the end of chapter 14 of your textbook. You'll be able to get some answers to the review questions by going to www.learnnowbiz. What you do there is you look for the textbook, which is on the website. The password for the answers is 4922. So if you want answers to questions 2, 4, 6, etc., they'll be available on the website. Answers to every odd question, that means 1, 3, 5, 7, etc., well, they'll be available in Connect after you have discussed and shared your answers on the discussion board. I'll give you more details about this later on.